Now, as we head into Asia, we want to start with China and some of the recent data that came out recently. The composite PMI was expected, the previous was 52.2, came in at 51. It really right in line with what we were saying, where a lot of pressure was going to remain. The manufacturing PMI was expected at 50, came in at 50.1, a little bit higher than we were expecting. We thought it was going to be a bit lower. And then the Caixin Chinese PMI was also expected at 50. That came in at 49.1. That was what we were expecting, just because we saw new orders, we saw what was happening on employment, and it was all negative. So that's why we thought there was going to be a move lower. Non-manufacturing PMI was expected at 51, came in at 51.1. Again, right in line with what we were thinking. We thought it was going to be with a 50 in front of it, but again, margin of error on that sense. So when you look at just the line, the new orders is the one that remains concerning, because when you look back the last few readings, it's negative. And that's the contraction, because it's an exporting nation. So when you look at new orders are going down, but it's also because inventories are building. So as inventories are building, you don't need new orders. And that's where we think there's going to be some of this pressure, especially when we look at Q1 and into Q2 of 2022 versus where things were and what expectations are for Chinese growth. So taking that to the next level, China manufacturing PMI for the Caixin side, you can see that drop. And then the non-manufacturing PMI, the official, again, you're seeing just the downward trajectory. Now, this is where things will start to level off. They're trying to do something to offset, which is why we've seen a bit more action taken on cutting rates, but they never raised rates. So the impact, again, law of diminishing returns, they've already had tax cuts. They're trying to do more, but it's very difficult when you've already cut taxes to the level that they have, and they have such a high government spending. These are some of the impacts that we continue to see rolling through. Now, the China non-manufacturing PMI new orders came in at 47.8. Deeply contractionary. You can see where they were, which is why we did think the non-manufacturing PMI was going to be a bit lower, because a lot of those leading indicators continues to be a bigger problem, especially when you look at some of the overhangs that remain, especially the employment side. So the employment side is where we're going to focus on at this point in time, because you can see that it keeps falling negative. Now, there's a lot of people in China. That's not surprising to anybody that hears that. But when you see employment contracting, it means that people are losing their jobs, and they have been. And that's where we look at what is happening to the consumer, and how is consumption going to be impacted in the near term. And that's leading into how much people can travel in the Lunar New Year, which started February 1st. These are some of the offsetting pieces that we remain concerned on going forward, especially when we're looking at employment. So, and then the inventory surged in 21. So Chinese manufacturers' inventory is excessive. So again, no new orders, excessive inventory. Where is this product going to go? And this is where the conundrum starts with how much can you trust some of the Chinese data? Because if you were to look at the export data, if you were to look at some of the Chinese consumption data, this is concerning, because what are the manufacturers going to do? They're going to have to slow down activity in order to clear inventory. And you can see just how excessive it is versus the previous periods of time, which is why we think that there's going to be a broader slowdown in China, even though others think that they're going to ease and they're going to do things. But this is, again, just another kind of feather in the cap of why we think there's going to be some forward problems. Now, savings have also stepped down. So China household savings rate declined in the second quarter. Looking at what has happened so far, so household savings rates continue to drift lower. And now as employment falls, that means that people are going to have less to put into savings, which is going to pull more out of savings, again, leading to some of these underlying problems. On the excess household deposits, they're still above the trend, so there's still going to be money that can come out, so it's not a huge issue in general, not yet. But again, leading to something that will be a bigger problem over the time period, as non-manufacturing PMI employment is now deeply negative. And when you look through 2021, it was very rarely positive. And when you go back through, it was never positive. It almost got positive in the beginning of 21, but now go back to 2018. Non-manufacturing PMI employment has been negative in contraction since 2018, and now manufacturing employment is negative. All of the key pieces that we continue to see as overhangs going into in this quarter, and how the consumer is going to be impacted. And now when you look at the manufacturing PMI by firm size, small firms massively hit the contraction. And then when you look at the large firms, those are the ones that continue to kind of hold their own, while medium firms continue to weaken a bit, but the small firms just get absolutely torched, which is why the CCP is trying so hard to protect the small firms, trying to protect where things are, because those are the ones that need it most. Now, on the real estate front, property front, Evergrande has said that creditors have moved to seize a Hong Kong plot. There's a 2.2 million square foot project, and was a crucial piece of collateral in a planned restructuring of Evergrande's giant offshore debt load. But the plan is now in turmoil after Oaktree appointed a receiver. So again, like, that was going to be used as collateral as a restructure. But if Oaktree claims it, then that just throws a wrench in how Evergrande can adjust their position. So when you look at PPI versus CPI, the gap continues to widen, and that's again going to pull down industrial profits. If industrial profits fall further, what is that going to do to employment? That is already contraction. And then what is that going to do to wages? What is that going to do to consumption? And you get an idea of how that continues, especially given that they're sitting on so much inventory that they're going to have to start moving it into the system. And that's why when you look at the lack of confidence dampens corporate earnings. All of the things that we've just said over the last 7 minutes leads to why we think there's going to be a bigger drop in that marginal spend, and and the concern across the equity side. Now, the financing squeeze is driving a deep decline in new construction. So new construction continues to be a problem, and this has typically been a big driver of growth. And so again, you don't have the consumer. You have some slowdowns in trading and in exports imports. You're not seeing a big increase in new construction, again leading to some of these problems. You have iron ore with a very elevated amount of storage, things sitting in iron ore sitting in storage. I just see a lot of problems in China that the market continues to ignore. But then when you look at China corporate operating income and GDP, income growth coming down a bit, income growth on the mean side also coming down, again bringing down that GDP growth. Still fast but breaking corporate income trend hides a very important feature, namely the sizable gap between the mean and the median of the growth rates. This means there is a growing divergence in better performance in large firms versus the lagged improvement in small firms. And that's why when we look at what is happening on the median and mean side, which is why we talk about the PMI of large, medium, and small firms, the pressure just continues to bring it to the downside. Now, industrial profits deeply missed versus pretty much every year except a few in December, and that's something that industrial profit side, we see that continuing into January. Now, shifting a bit to some of the positive, Taiwan crushed it. GDP was expected at 3.85%, came in at 4.88. PMI manufacturing came in at 55.1, still very strong when you take GDP against the trend line. Still very robust, and we don't see that stopping based on the shortfalls in semis, in tech, which again is going to support pricing, hence also supporting their GDP. This is just kind of showing what we had been saying, that Taiwan manufacturing PMI had peaked. It would come down to about we were saying between 54, 56, and then just going sideways. Here we are, and we don't see that changing at this point in time. On the India front, the 8 infrastructure industries got a bit better, coming in at 3.1%. GDP annual estimates year over year it was slightly better than prior, coming in at negative 6.6%. But then when you look at some of the slowdowns that are happening that we've been discussing, manufacturing PMI came in at 54, previously was 55.5. PMI services was the big miss, was expected at 55.5, came in at 51.5. And the same service issue, again, the wages, inflation, India is still subject to the same thing, impacting spending, bringing the composite from 56.4 previously to 53. We do see more downside on the service front, which is going to put pressure on just the general composite. Manufacturing, we think it stabilizes at this 54 level. It's really the services that is going to see additional pressure as inflation shifts up again. And again, that's going to pull down that underlying PMI. 8 core industries, getting an idea of just the output still strong, even as the manufacturing index kind of comes down, but will hold firm at this level. Then when you look at sales managers index, still staying just at a fairly flat level, but staffing has paused. And that leads us to, again, that inflation front, wage front, and jobs, which is why we do see more pressure on spending, because we don't see the staffing getting much better, which is going to impact how much people can spend. Vietnam on the PMI manufacturing was expected at 52.5, came in at 53.7. We think Vietnam is going to continue to be strong. Exports, though, came in much weaker than expected. It was expected at 21.1, came in at 1.6. Then imports were expected at 12.8, came in at 11.5%. So imports are still well above exports. We do think there will be a recovery. It's just going to take a little bit of time. And retail sales did recover. They were previously at negative 3.8% and came in at 1.3%. So we do think that you're going to get a nice bounce, especially on the trade side, just because imports still outpaced. Exports will recover. Some of that is timing delay. We did have an increase in retail sales, so it's going to be something to watch and a good growth driver going into Q1. This is just putting into perspective. There had to be some normalization when you look at year over year. So again, still strength, still growing. Imports are still well above exports. So we do think that there's going to be some additional growth. And then when you look at Vietnam PMI, it's still trending higher. We think it levels off. And GDP per capita versus the peers, we still think that you're going to get a fairly strong GDP number from Vietnam this year. Now, when we look at Japan, kind of a mixed bag. Industrial production was slightly worse, was expected at negative 0.6, came in at negative 1%. So retail sales, again, also missed, was expected at 2.8%, came in at 1.4. Month over month was expected at 0.3, came in at negative 1%. Japan, again, it depends on where we're looking at. The consumer's still struggling, and that's not. I don't think that's going to change. On a manufacturing industrial production side, things are getting better, especially on the car front. So we do see industrial production bouncing, but retail sales still being under pressure. And that's being shown. Consumer confidence falling a bit, expected at 37, coming at 36.7, but the prior was 39.1. So again, the consumer's getting more concerned, and you're seeing that show up in some of the other capacities when you look at PMI services. PMI services previously was 46.6. Slightly better at 47.6, but still negative, still in contraction. And that's something that we think continues through Q1. And the PMI composite was previously was 48.8, came in at 49.9, still contraction, but improving, because we do have a step up in manufacturing that should bring the composite positive and into expansion and above 50, as the services side still continues to struggle. So that's all we have for you today. For the first time in a long time, the Asia segment is actually probably the shortest one out of all of them. So hopefully we summarize everything for you. And if you have any questions, again, you can find us in the YouTube comment section, or you can contact me on Twitter. Thanks again for watching. I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network.